contractors have a problem with cash flow, and it's I think the biggest problem in small construction companies is cash flow. So I think let's talk about that. Let's talk about how we manage cash flow, what we do to make sure that we that our cash flow is healthy. Some of the solutions we've put in place, even the variety of things, the timing. Well, let's talk about it. So what do you?
Cash flow is a tough one. So there's, obviously it depends what type of jobs you're doing, and there's factoring companies if you are, working in maybe the commercial space and you're net 90 or net 120, right? There's factoring companies that will loan you money against your invoices, right? I know someone that they do like gutter cleaning and vent and chute cleaning of buildings, of multi-unit buildings, right? So they're all like, some of these buildings are like net 6 months, or net 3 months. So they use a factoring lender to, because they got to send out, and they do it nationwide. So they got to, the expenses of sending people out to a different state, putting them at hotels, and so they gotta come out of pocket. So they're using factoring, but so there's different, it depends what you're dealing with, and a lot more about like that side of it, the financial side, the lending side of it. But as far as just nitty gritty, making the cash flow work. So number one is payment schedules with clients. Considering they have a residential company, there's no, you're getting milestone payments. So net 7 days, net 14 days. And milestone payments are crucial. So setting up the milestone payments with the client where you're this is a big mistake. Construction companies, we're not in the business to finance jobs. That's not supposed to be, right? If we're making a 10, 20, 25% net, there's no margin in there to finance the job.
Yeah.
We're not supposed to be. We're not a finance company. Yeah. We're not, right? We're not banks. Yeah.
Well, it's important to say one thing too about the distinction between California law, contractor law, and the rest of the country, pretty much the rest of the country. And so we work in California, so we're confined by a rule that the contractor state license board, our licensing agency, requires all contractors to deliver work before we invoice. So we can't take payment in advance of services.
Correct.
Every other state, to my knowledge, most other states
like
allow
50% up front,
you can get 50% up front. You can be working off the cash. You can where we're concerned, we have to give a detailed payment, a milestone payment schedule. We're allowed to take a little bit for
materials, yeah.
But our deposit, our initial deposit on any job, it can't be more than $1,000, even if the job is a skyscraper. It doesn't matter.
$1,000.
$1,000.
We have $4 million jobs. Our deposit $1,000.
Yeah, it's ludicrous. It's insane. But it's California, and they think they're protecting the consumer. What they do in actuality is they create a cash flow nightmare for the contractor.
Right.
So obviously now, given that world, and those are our constraints.
Yeah. If you can make it here, you can make it anywhere.
Exactly. On that. Yeah.
But we get creative. That's the answer. So obviously this is the biggest uphill battle. Like I said, if you could do it here, you can apply this anywhere, but we got to get creative. So for example, $4 million project that we're actually starting in like a week. So $1,000 deposit, right? Obviously I'm not going to go start a $4 million project without, so I get creative with the milestone payments and what they're called and what they reflect, right? Because
I would say we're specific, and not creative is the wrong word.
Not creative, meaning at start of demo, right? I got to send dump trucks there. Right. I got to pay deposits to my
You're accounting
demo.
for all of the expenses in that progress payment and making sure we cover it.
Right. because I'm starting the job. No, what I mean by creative is I'll do at start of demo, because I have to pay deposits to my demo subcontractor. Some I have relationships with, and they'll bill me after. But for all intents and purposes, have to pay a deposit or have some mobilization money that I need to pay.
Right.
And again, my intention whenever creating and training my teams on creating these milestone payments, and they directly connect to milestone payments of the subcontractors, which I'll get to, is that we're not a bank.
Yeah.
We're not in the business to fund this job, right? We're in the business to get paid and paid out.
Right.
Right. I'm not here to float money. And then like clients sometimes are under this impression, like, what do you mean? You're supposed to float, right? Don't you float it for like 30 days? Like, and they take their time. Like, no, dude, like,
Yeah.
I know, like I get paid and I pay out, right? Well, as well, again, the buck always stops with us. If I don't get paid, I still need to pay out. Right. But the hopes are that I'm getting paid and I'm paying out, right? And sometimes there's the reality that you do need to float for a week or two, but so you got to have cash reserves for that, or sometimes even a month, or sometimes you can have problematic client that doesn't want to pay. Then you got to have those cash
reserves. Yeah, you got to be able to cover it. Yeah,
yeah. And in California, we can't stop the job unless there's like very, very big reasons for non-payment, and even the verbiage of that, like, it's a consumer protection state.
Yeah, very pro-consumer.
Right? Yeah. So for us, we always continue because we don't want to get like abandonment of contract, non-performance. Like, so you always have to have cash reserves. Now, I didn't have cash reserves when I opened up the business, right? So it's being, maybe creative is the wrong word, but being precise with the milestone payments.
Yeah, you have to know your expenses at each milestone so that you can account for them with the customer's invoice payment. Right.
Exactly.
And I think another thing too that we're getting better at is payables tempo, the tempo of your payables, because a lot of times, our guys, our subcontractors, they're in such a they're so eager to be paid immediately upon completion of the job for the same reason we are. They're not in the business to finance anything, but the payables tempo, you want to ideally with any business collect more than you pay out, right? And that obviously, but then also collect faster than you pay out tempo wise. Right. The combination of the two of those improves cash flow. And it sounds intuitive or like a no-brainer or something like that, but it's not, because the demand that we spend, and I'll admit this because it's true, and I don't know that there's a way around it, but we spend way more time on our payables every single week, just in terms of man hours internal in our office, than we do on our collections, like 5 to 1 maybe. Right. And if you can, and what we're going to do over time.
We started changing it.
Yeah, we are. And I'm conscious of it. So it's like something that I'm believe me, I look at that every week, and it's, you get punched in the stomach by bad work on the job. Yeah. My punch to the stomach every week is knowing we're spending 5 times the man hours on payables as we are on receivables. And for me, it's like, I want to change that so that our focus is, so that payables is the lighter lift, and receivables is the thing that we're more focused on, concentrating on, all that stuff. So that just that quick reversal. And I've been in this solar company, we had a department we had more people in our billing department, billing meaning receivables, than we did in our payables department. Right. Like it was like 2 to 1, but it took a while to get there. It was always the opposite first. Then when we finally got there, it was like, okay, now that you immediately saw like an improvement in cash flow immediately. Yeah,
because I think the employee naturally they have a relationship with the vendor, the subcontractor. So there's this like everyone's pushing in the company for the subs and vendors to get paid, right? Because they're dealing with them on a daily basis, but they're not thinking about that like kind of about our money, right? Some of them, there's exceptions to the rule, but it doesn't make them bad. It's just like, again, they have relationships with these subs and vendors. They're dealing with them on a daily. Right. And they get, they want them to be paid. So you changed this tremendously for us. We were looking at the books and we were like, we're making money, but our cash flow sucks, right? Like we're like and you were like, we just got to slow down the tempo. This is a very good point. And I struggled with this. And Mike, when he came on board, fixed this was, dude, slow down the tempo of payment. I was like, what do you mean? These guys live hand to mouth. So it's nothing major. We did net 14, which might sound crazy to some of you that are paying maybe net 30, but for us, we pay you put in your invoice, Wednesday by 3 p.m. We'll pay you Friday, right? And what would end up happening is we would spend, some people in the company would spend essentially the whole Wednesday evening, the whole Thursday, and basically the whole Friday getting it, because then paying everyone out. So we're like, slow it down, net 14. We have those, that week and a half to review it and approve it not right. And it's not like everyone's spending 2 days just paying people out. So yeah, tempo is super important. But I'll just finish it with this, connecting the subcontractor payments, everything has to be aligned. So their milestone payments, if you have at start of demo 50,000, their start of demo, let's say it's a demo, you have to have your margins worked in. So it needs to be, let's just say 30,000, just throwing a number out there. But if your margins are 40%, because you have 20% for overhead and 20% for profit, then you need to be collecting that more, right, from your receivables than what's paid, because otherwise you're just collecting 10 and paying out 10, right? So that's another important note on cash flow, which is you got to set up the payment schedules to reflect what your profits are of the project, right? And overhead, right? So again, if you got, whatever, just for easy numbers, if you got, 50% margins, so you're collecting 50,000, you're paying out 25,000, right? You got to make sure those payments make sense. Otherwise, you're not going to have money to take home, even if you're doing it correctly with the lining up the payments correctly. But if you're not making sure that you're collecting more dollar amount or more money than paying out, you're going to also have a kind of, because you got to be able to take money from every payment and move it towards your tax account, savings account, right? And you're not going to take it at the end of the job, right?
No, you still have operating overhead too. I mean, we have project managers, everybody's those are operating expenses, and so it's always, I think the key takeaway is it's always easier to pay out money than it is to ask for money, and you just have to get into it. And it's probably easier to solve in a larger company because you could just put more resources behind it. So if you have more people assigned to it, then theoretically you're going to be putting more energy behind it or whatever. But in a small business, it's the mentality of it. It's just making sure that an equal amount of time is spent on receivables. So yeah, and I think the other key takeaways those are the key takeaways with cash flow. I mean, that's, they're unfortunately, the other way to solve that, I think there's one other thing I would say is the other way to solve that would be understanding or leveraging debt. If you can leverage debt the proper way, then I've had a lot of success doing that in the past. We're doing it a little bit now with short-term friends and family loans that just give us a cash flow cushion, and I think that's really successful because that's like it's if you can get the capital cheap, your friends want you typically and your family typically want to help you out. You're securing it with business assets, so it's not like you're not asking them for like an investment and then you're waiting 3 years to get their money back or something like that. And you can pay them a relatively decent interest payment every single month. And like I've had tremendous success with that. I think that's the one way, especially in California, you can account for because I get the capital cheaper even than factoring. Yeah, and that's kind of the goal is to and again almost no one qualifies for factoring. If you don't know what factoring is they typically use it we call it factoring, but it's accounts receivable financing. Right. So you can look that up and get an idea of what we're talking about here. But
you need to have invoiced already.
And you have
can't
to
be like future business. You need to have invoiced for it and waiting for that payment.
Correct.
And then they'll fund you for it.
So you still have had to deliver exactly.
That's why I gave that example of that company, right? Like they'll invoice and they have to wait 6 months.
Yeah. And that's a and also the banks that deal with those kind of, it's typically a bank or a financial institution that will give you that kind of capital, but they have to know the people who are paying you. So they have to know the companies you're being paid from, and they have to have like an A+ or AAA rather credit rating and all that stuff in order to do it, or at least a AA credit rating.
Yeah, underwriting is pretty intensive. Yeah. So just want to add this in. We invest into companies. We look at companies that are healthy companies, might need capital for scaling, rolling up other companies, buying other companies. So if you're in the market and you feel like you're a healthy company, you just need some capital to grow, definitely hit us up and we can talk about that.
Yeah, and we can also help with capital structures like debt structures and stuff like that for anybody who wants to understand how to create a friends and family offering, because we've done it a lot. We're working on them right now, or in other words, we have friends and family involved right now that have lent to us, and so it's
we
pretty
built out a
successful
fund.
stuff. Yeah,
We built out a fund. Went first to friends and family, and we have capital that we look for interesting deals, right? So if again, I just put it out there, and if you feel like you have an interesting company and there's an opportunity there, we definitely want to talk to you.